Next stock on the list is actually the behemoth itself, Intel, the largest semiconductor. Well, actually was at one point, but not anymore by market cap. But it's one of the largest semiconductor companies in the world. It seems to have gotten quite a beating. Everyone's kind of, pessimistic on Intel. And we're going to look at the numbers here. We know that their competitors are AMD. They're very famous for their CPUs. So is AMD. I think Austin has an AMD build back there. So before anyone thinks that
an AMD build,
we're Intel shills, he is an AMD fanboy. I am neutral party. I will buy whatever product is good. All right. So let's get into the numbers here. So with Intel, plug that in, and then let's do our standard 15%. And then we do for Intel, I know off the top of my head, I don't think that they're growing very much. So I think it's going to be, let's do 5%.
Are we doing like the 5 to 10 percentage range, Fabio? Is that the range that we're
3%? And then let's actually get a little lower, 2%, 1%. Very pessimistic outlook on Intel there. Let's assume the buybacks, that I would assume the buybacks. And let's not assume that 3.5%. Let's assume they do 2%. Okay. So what I can see here is if I think the business is going to grow at about 5% per year, I do not want to invest it. I need to expect higher than 7% at a minimum. Or I have to somehow assume that the buybacks are going to be greater. And I'm not including dividends. I'm not including reinvested dividends. I'm just including buybacks and the growth of the business itself on a cash flow basis. I think that it's important. Let's see what would happen if we assumed a 10%. So 10% is fantastic. Well, not fantastic, not fantastic. It's there. It's cheaper. Let's do a 9% just to play around, and then an 8%. Okay, so 8 to 9 is what I have to expect at the current prices. If I can get it lower, I'm getting a larger margin of safety. Real quick, let's take a look, Austin, and then I'm gonna ask you some questions here. What do you see here? Do you notice anything about the PE versus the price to free cash flow?
I see that the price to free cash flow is higher than the PE, which could suggest a downside surprise.
Small one, not too terrible.
Yeah.
But it's not as cheap as people think. That could be for a variety of reasons, but it's not too terribly different that it should sign out a red flag. Altman Z score is looking nice.
Is that a book value of $21 a share, Fabio?
Yes. So with AMD, you don't want to assign too much to the book value because they are a fabless. No, I know, but AMD.
Okay.
AMD, you don't want to assign too much because they're a fabless. Intel, however, is not fabless. All right. So they actually do produce chips and they have their own factories. Or foundries is more the proper term. So you actually want to consider the replacement value of all those assets, but they do have a lot of assets on top of that, such as their IP and the technology behind that. And so far, so good. Nothing too crazy. Return on equity is fantastic. Return on invested capital is pretty good. Could be better. I like to see that going above our required rate of return. Return on equity is really good though. Return on assets is good because you got to remember they're an asset heavy business. So 12% is really good. On AMD, you should see a better number than that. Okay. If you don't, that's not a good thing, but I imagine it is actually. If we, I think we have an AMD video where we used the model maybe in that one, but anyway, we might do an AMD video in the future. So some key ratios, let's focus on the top ones for now. So we can see here, current ratio. Looks good, Austin?
It does.
Good.
And then I also like that cash ratio.
Oh, yeah, that cash ratio looks good. It covers, that's the most conservative of the liquidity ratios. It implies that the entirety of the cash can pay off all the current liabilities. Anything else stand out to you before we move on to the next one?
A 55% gross profit margin, Fabio.
Yeah, and it's declining. That's the negative.
Yeah. That is.
So always within relative to itself, we have to consider that. So it's declining. That can be a sign that is indicative in finance of declining performance versus competitors. So probably competitors are coming in, and just without knowing the context, that's what I would assume. I know the context, and that confirms that they're losing market share to AMD. Operating margins are improving. This could be because of synergy. Well, they improved and then they got worse. Okay, so better than 2017, so they probably got more efficient, but net profit margins declining. But that could be, again, they're probably maybe investing more. ROE, we talked about that already. So these are good.
Well, isn't there a camp on YouTube, Fabio, that is saying that Intel is going to hit bankruptcy in essence?
Oh yeah.
You want to explore that? I mean, yeah, of course not. But do you want to kind of explore why this kind of sentiment exists?
Because it's team red, team blue, man. It's team red, team blue.
Fair.
AMD was the underdog, and now they've risen. And now everyone who's hated on Intel wants them to suffer. That's understandable. I understand that. And I just think that people need to calm down with that a little bit and kind of think about things from different perspectives. But earnings quality looks okay. It's actually, no, actually it's pretty good. It's pretty good. That's
so
a
Fabio,
good one.
What is earnings quality for some of our audience who might not know?
It's measuring you accountants, how good you are. Right?
I know it is.
It's my own personal grade on accounts. I'm not, you're not really going to maybe find anyone talking about that kind of measurement. That's kind of my own measurement. But yeah, earnings quality is how I measure the accounts, and the higher, the better. Earnings quality has gone up and down, but above 1 is good for me. Again, you won't really find out what that is if you look it up. I don't think it's anyone's. I came up with that for myself. You can always come up with your own ratios. It's personalized. Ratios are personalized in the finance industry.
Yeah, right, I was actually about to ask that too. Just would you even kind of go over why kind of almost coming up with your own financial ratios could be really beneficial to you when you're analyzing an investment, let's say?
Yeah, well, I want from this channel to help people think for themselves. And we can be kind of like a stepping stool, a tool, a free tool, a resource for other people to learn and better themselves. That's the point of this. And the purpose of creating your own ratios is once you become confident in yourself as an analyst, as an investor, you start to maybe think as yourself, like a business owner. And then you start to say, well, okay, I think that's important for this business. Well, how do I measure that? Well, then you use math, very basic math, and you come up with your own ratios to measure that performance. And then you measure it across time. And then you see, are they getting better at that? Are they getting worse at that? Now, it does require you to, to have some basic understanding of math, just division ratios, basically, which is just division. And of course, you got to know to memorize the proper thing to target that exact metric. Most people just use the common ratios that the finance industry has created over the years, but there's nothing really stopping you from creating your own. Of course, you could be ineffective. I'm not saying that anyone creating any ratio is just, oh, it works. No, there's some nuance to that. But for the most part, once you become well experienced, there's nothing stopping you from saying, oh, I want to track that. And maybe there's not a ratio in existence, but there's nothing stopping you from making one. But anyway, that's pretty much it. There's some ratios that you and I have come up with together. We just came up with one tonight.
Yeah, for REITs.
Because we wanted to measure REITs in a specific way. But we'll get to that. So then inventory, nothing really stands out here. So I think, daily sale inventory, we know we're getting in a supply crunch. So I'm just trying to provide some context there. So it's getting lower because there's a supply shortage. So everything they're making is selling out. Okay. So Austin, closing thoughts real quick. Intel, interesting or not interesting? And I'm going to go back to the summary report so you can refresh yourself on the.
Well, even just the entire thing about the team red, team blue. I'm personally interested in diving deeper, doing the due diligence on Intel to try to see personally if this is something I might actually want to invest into, to be completely honest with you, because I like the company. It's been around for a while. I like their business model. I understand the industry that it's in because I like AMD. And I would want to see through further due diligence, I would want to see us come up with a discount rate pursuant to the risks that you and I find while doing our due diligence, for instance, if that makes sense.
Yep. And I would I would try to command a higher discount rate for technology companies because simply the moats can be destroyed at any moment from some new technology that, neither you or I, sorry for the stuttering, neither you or I are semiconductor engineers. And so we have to price in that risk of uncertainty that we both have because we are not subject matter experts. Unless you are out there, you're a subject matter expert, you're a semiconductor engineer, and you know which one's going to have dominance, then you can apply maybe a lower margin of safety, but that's individual. So my closing thoughts, I'm interested in learning more about Intel and then its competitor AMD.
We hope that you've enjoyed what you've seen here today. If you have, please be sure to like, comment, and subscribe, and visit our website at capitalmindset.org. And we look forward to seeing you guys later.